Hello, welcome back. I'm going to start this episode with a bang, as you'll see here. Kevin O'Leary says it's crazy to avoid Chinese stocks and it makes no sense whatsoever. It is a thesis with which I totally agree myself. And I kind of wanted to start this video with this one. Kevin O'Leary, a very well known Canadian businessman. Most people know him from the Shark Tank and other similar types of TV shows. But I do have a little bit of a video here, and this is going to be a couple of snippets which I think are very interesting. And Kevin O'Leary is making some great points that I do make in my videos at times. But I really wanted to play that. It's going to be about 20 seconds or so. So let's listen to this one.
It's such a great question you're raising here, because if you're looking for long-term secular growth, there's no question the Chinese economy over the next 25 years is going to become the largest economy on earth. There's no stopping that and no denying it.
So as you can see here, and I forgot to tell you that the question basically that the journalist made was about whether it's a good idea to invest in China or not, based on the fact that the stocks have been going down. And this is what Kevin O'Leary is responding to here. So let's listen up.
There's an economic war, a technology war, a regulation war going on with the United States. That too could be temporary. We've seen this happen in semiconductors, where they're no longer allowing certain chipsets to be shipped to China.
Very interesting point and a very fair point here, which I have also mentioned in many of my videos. I do think this whole situation is temporary. I don't think it's going to last for a long while. And this is what Kevin O'Leary is mentioning here.
But frankly, these economies need each other. So to have no allocation to Chinese markets,
A little bit of a glitch here.
makes no sense whatsoever. Volatility. The Chinese consumer is emerging. I own China stocks. I have an index of them.
So what is he saying here is that the two economies need each other, and of course that's obviously true. And you can't really have China tumble forever and the US being great forever. This is going to diverge at some point, and actually, frankly, we're seeing China potentially actually getting a little bit higher in terms of economic growth from the US. Now, he's holding an index fund here, and listen up to what he's telling next.
Particularly global internet behemoths, large companies like Alibaba and many others that are the reflection of what the American economy's gone through. If you own Amazon, why don't you own Baba? The same idea. The Chinese are using online services the same way.
That's what I wanted to say. Pretty much, if you own Amazon, why wouldn't you own Alibaba at a much cheaper rate? Is what Kevin O'Leary is wondering here. And again, it's something that I have mentioned myself in multiple videos. There is really no point in buying the more expensive thing, and just leave the cheaper thing that is similar in terms of quality behind. And Alibaba is one of these. And this, I think, is a very fair point here. He's talking about Tencent as well here.
Tencent, others, they're there because that consumers.
He just mentioned Tencent. It wasn't too clear. I can go back.
Others, they're there because
over here.
The same idea. The Chinese are using online services the same way. Tencent, others.
Yeah, Tencent.
They're there because that consumer is demanding it. So there's a lot of political issues around Chinese stocks, the threat of delisting them. But all of that is noise.
Exactly. That's what I wanted to say, and that's how I see it myself. All of that is noise for the time being. And of course, it can still keep dropping the economy, the Chinese economy, and many Chinese stocks for a while. But I don't think it's going to be lasting for a long time. Now, today, Alibaba is actually up about 4% right now. You will see that in the last week, things have been doing better for Alibaba. Let's see if that continues. It may not. It may actually tumble once again, because again there is issues with China and the overall market there. And a couple of things that I wanted to talk about. Alibaba, largely controlled by institutional shareholders who own 35% of the company. That's not too much, actually. There are many companies who are like 50%, for example. Now, this can be a bad thing and a good thing as well. Like if you have too many institutions holding too much, that can actually drop the price even more if there is a sell-off, for example. And also, when you have less institutes having bought into the company, there is more potential for new ones actually buying into the company and increasing the prices too. So there is some bad things and some good things that can actually be a sign of that one. 30%, I think it's fairly healthy for what the typical investor would want to achieve here. Now, you will see there's a good portion of institutional money invested in the company. Is usually a huge vote of confidence in the future, is what you'll see here. And you'll kind of see a breakdown here. The general public owes about 35%, which is the same as institutions are holding over here. And yeah, it's you can kind of see it as a balanced picture right now. A lot of actually money has moved out of Alibaba since a while now. But again, it may be that you're going to be looking at them potentially getting more when the dust settles here. So you do see that from institutions when the economic stance changes, they get rid of a stock and then rebuy later when things get better. So if you're buying at this price point, it may be an interesting purchase and just have it and wait for a while. Is also what kind of we were told from Kevin O'Leary there, and as I mentioned, I definitely agree with that stance. I'm buying this one for many years to come, and so I don't really care about what's going to be happening in the upcoming like 6 months or so. I do recognize that the stock could go down lower, and my only fear would basically be to not have cash to buy more, frankly, to tell you the truth. Now, another thing here, Alibaba, another article that I thought was rather interesting here. They say don't give up now. I mean, I wouldn't myself, but you will see some interesting points in this one. Now, they believe the sell-off indicates a move to de-risk Alibaba ahead of the pivotal National Congress. China's economy has also improved in Q3. Now, you will see here that the thesis that they have over here is that Alibaba basically has been continuing to fall, and amidst this climate, they do see China, having a little bit of a worse economic growth here. You'll see that they are attempting to close the gap toward the initial 5.5% GDP growth. It looks still challenging. There is a forecast of 2.8, as you will see here. And they have dropped, as you'll see here, they have reiterated, that's the authors, the buy rating on Baba with a medium term price of $95 over here, which I think is very, very conservative for what it is. But you will see what they are mentioning here. China will hold its pivotal 20th CPC National Congress in mid-October as Chinese President Xi Jinping looks to secure his third term. So investors had hoped that Xi could loosen the zero COVID restrictions after the Congress, helping lift the malaise seen in China's economy over the past year. Interesting things to see here. Now, another interesting point here, passenger trips by road are expected to plunge by about 30% from a year ago during the National Day break, according to government data. Prices of air tickets for the period are lower compared to last year as well. And cinema box office takings are expected to decline also by more than 20%. So that's not great really for the Chinese economy overall, for at least for the upcoming period, I suppose. Some interesting things to see. And yeah, revisions seem relatively muted here. I guess most revisions are kind of going sort of like neutral to kind of lessening their negative impact that they have been having for a while now. They kind of potentially think that the worst is likely over at the moment. Now, again, we don't know. You are going to see here that it really depends on COVID restrictions, what's going to be happening with China, of course. We do know that, and you can kind of see the insane downtrend that we have been seeing lately. But overall, I think that with Alibaba being priced as it is right now, at a very interesting price point, still sitting at $83, and this is a company that is generating tons of money and has an amazing cash flow has amazing cash inflows, pretty much free cash flow inflows. I think this is a fantastic opportunity and it's pretty cheap right now, and they do continue buying back shares and all that. Again, we have talked about Alibaba. I'll probably make a video just to deeply analyze Alibaba as well, probably make a dedicated deep analysis for Alibaba. But I just wanted to make this one because I thought these remarks from O'Leary and a couple of articles that I shared here were rather interesting to talk about. And I thank you for watching this one. Remember to leave a like and subscribe, and I'll see you soon in the very next video, guys. Bye bye for now. See ya.